The 30-year amortization is here for first-time buyers in Canada, and most buyers in Spruce Grove, Stony Plain, and West Edmonton still do not understand what it actually does, who it applies to, or where it can quietly cost you money. I'm Murray with the Zelinski Realty Group, a licensed realtor and mortgage associate, and today I'm breaking down the real numbers so you know exactly what this change means for you. If you're currently considering purchasing a home and want to know how your numbers look in comparison between a 25 and 30-year amortization, message me directly with 30 and I can provide a complimentary analysis so that you can make an informed decision as to what the best direction is for you. Okay, let's look at this a little further with the first point of what changed and when. And I'll provide some clarity here as there has been some confusion for buyers. This did not just happen last week or last month. The 30-year amortization first showed up back in August of 2024, but it was extremely limited. At that point, it only applied to first-time buyers purchasing a brand new build. If you were buying resale, you were completely out of luck. Then in December 2024, the federal government expanded it. And as of December 15th of that year, first-time buyers could now get a 30-year amortization on any insured purchase, a new build or resale. At the same time, the insured mortgage price cap was raised from $1 million to $1.5 million as well. So if you've been assuming this only applies to new construction, that is not the case. It does not. That is exactly the kind of gap that gets buyers either missing out on a tool that could help them or misusing it and paying more than they need to. Second thing we're going to look at is who actually qualifies. Here's where I definitely see some of the confusion mostly. 3 boxes need to be checked. First, you need an insured mortgage, which means your down payment is under 20%. But important to note here, you also qualify for the lender's best interest rates since it is an insured mortgage. Second, the home must be owner occupied. No rentals, period. Third, you need to meet the definition of a first-time home buyer, which means at least one borrower on the application must be a first-time home buyer. For example, if a married couple wants to buy a home and one of the partners owned prior, they can still qualify if the other had not owned a home. There is another criteria, which is if there's a 4-year gap between prior home ownership and the time of buying another home, that could qualify. The other thing to note too is if you are a current homeowner and selling your home, you can still qualify for a 30-year amortization if you buy a new build specifically. A new build is defined as a home not previously occupied for residential purposes. So technically, even if the home was built 2 years prior but never occupied, it will still qualify. Now, along with meeting those guidelines, you also need to pass the federal stress test, which is qualifying at the higher of the contract rate. That's the rate the lender is offering you plus 2% or 5.25%, the greater of the two. A credit score of 650 is needed, but 600 is the minimum requirement as long as one of the co-applicants is at 650. Also, there's a requirement with debt service ratios to be in check. That is specifically the GDS and TDS ratios, which are known as the gross debt and total debt servicing ratios. As a side note, check my other video on mortgage qualification for more details around the ratios and the stress test. It's very important to know how the increase in interest rates affects your purchase price. Alternatively, if you want a quick breakdown on how those ratios align with your situation for qualification, just message me with ratios and I'll connect further as well too. So as a quick recap, if you already own a home and not buying a new build, or if your down payment is 20% or more, this program is not for you. But if you are a first-time buyer anywhere, Spruce Grove, Stony Plain, West Edmonton, this is worth understanding in detail because it directly changes what shows up as your monthly payment. So the third thing we're going to look at is why this all happened. This was not a random policy tweak. It was a direct response to affordability. A 25-year amortization was standard for insured mortgages for a very long time. But as home prices climb faster than incomes in most of the Canadian markets, the government needed a lever that could bring the monthly payment down without needing interest rates to drop first. By stretching the repayment period from 25 to 30 years, that is exactly the lever the government wanted. It's important to note it does not reduce what you are borrowing. It reduces how fast you are required to pay it back, which in turn lowers the required monthly payment. This can also make qualification easier for buyers who are payment constrained rather than down payment constrained. So the fourth thing we'll look at is the real numbers. So we're going to break this down because this is the part that actually matters. So let's run some real local number price points. Say a purchase price of $400,000, which is a realistic entry price point for first-time buyers. If you're looking at Spruce Grove Stony Plain, we'll see those kind of values kind of hold rather steady. You take a down payment at 5% is $20,000. That leaves a base mortgage of $380,000. Now, here's a step that not everyone is aware of. Since your down payment is under 20%, this is an insured mortgage, which means you also pay a CMHC, which is the Canadian Mortgage Housing Corporation, default insurance premium. That premium gets added on top of your loan. That premium covers the lender in the event they need to foreclose on you when you are in default of your mortgage payments. At 5% down, the standard premium rate is 4% of your loan amount. On the 25-year amortization, 4% of $380,000 is $15,200 premium, which is added to your loan. Now, your total insured mortgage becomes $395,200. So here's the part almost nobody talks about. If you choose the 30-year amortization, CMHC charges an extra surcharge on top of the standard premium. It's 0.2% surcharge, which is straight from CMHC's own schedule. And I can drop the link with that guideline below so you can have a look at it for yourself. So let's go back. On the 30-year amortization, your premium rate is not 4%, is now 4.20%. That is $15,960 premium on the same $380,000 loan. This brings your total insured mortgage to $395,960, about $760 more than the 25-year option before you even factor in the payment schedule. Now let's put both of those totals through a 5-year scenario of a fixed insured rate of 4.19%, which is right in line with where insured rates are sitting today. On the 25-year amortization, your monthly payment works out to about $2,120. On the 30-year amortization, your monthly payment works out to $1,926. That's a saving of about $194 every month by choosing the 30-year option. Over a year, that's more than $2,300 staying in your pocket or available toward qualifying for a home that fits your budget more comfortably because, again, the change in payment affects your debt ratios, which affects your purchase price. So the catch that nobody talks about is this. Here's the part I wanted you to consider because a lower payment is not automatically the better decision. Stretching your amortization from 25 to 30 years does not just spread out the same interest, it changes how much interest you pay in total. Assuming the same rate held for the entire life of both mortgage, which I get is a simplification, since your rate will renew on the term maturity for the life of the mortgage, the 30-year amortization in this example costs approximately $56,600 more in total interest over the full life of the loan compared to the 25-year option. That is on top of the extra $760 upfront premium from the surcharge. So the honest way to think about this is not 30 years is better or 25 years is better. It's a trade-off between cash flow today and the total cost over time. If the lower payment is what gets you into the home that would otherwise be out of reach or gives you breathing room for a young family's budget, that is a completely valid reason to choose it. If you can comfortably manage the 25-year payment, you will build equity faster and pay less interest over the life of the mortgage. The other thing to consider is this. There's also nothing stopping you from taking the 30-year amortization for the lower qualifying payment, then making extra lump sum payments directly to the mortgage principal to pay it down faster. Most insured mortgages allow prepayment privileges anywhere from 10 to 20% per year on the principal balance without a penalty. So this is not a permanent locked-in decision the way some people assume it is. This gives you flexibility. What this means locally. Here's why this matters specifically if you're buying a Spruce Grove, Stony Plain, or West Edmonton. Average home prices in both communities are sitting in the high $400,000 to low $500,000 range for detached homes, averaging closer to $540 in both markets. For a lot of first-time buyers, especially anyone buying solo or a young couple just getting into the market, the gap between the 25 and 30-year payment on a home in that range can be the difference between qualifying comfortably and being stretched to the limit on the stress test. That is exactly why I wanted to break this down using local numbers instead of generic national examples. The math changes depending on your price point, your down payment, and your specific lender's rate. That is where having someone who actually understands both the real estate side and the mortgage side in this market makes a real difference to you. So to recap, the 30-year amortization has been available to first-time buyers on any insured purchase since December of 2024. It can lower your monthly payment by putting more breathing room in your budget, but it comes with a 0.20% surcharge and more interest over the life of the loan. Remember, neither option is wrong. The right one depends on your numbers, your budget, and your plan. If you want me to run your actual numbers, whatever price point and down payment you are considering, reach out and I can personalize your number scenario. Also, if you found this video informative, please subscribe and you'll be connected to the new videos on the topic of real estate and mortgages, along with local market updates, keeping you in the real estate loop. I'm Murray Zelinski with the Zelinski Realty Group, simplifying the real estate and mortgage process just for you. Cheers.